Right now, more than 70 million Americans are counting on Social Security to pay the bills. And if you're one of them, or you love someone who is, the next few minutes could literally put more money in your pocket, because in 2026, Social Security changed in 7 significant ways. Some of those changes mean more money coming in. Others could quietly eat into your benefit check if you're not paying attention. And one change, a brand new tax break, is something millions of retirees don't even know they're entitled to. So stay with me all the way to the end of this video, because change number 7 is one of the most important ones for people living on a fixed income, and it's one of the least talked about. Let's get into it. Social Security isn't just a program for roughly half of all seniors in this country. It provides the majority of their monthly income. For many low-income retirees, it's the only income. When Social Security changes, everyday life changes, whether that means being able to cover the electric bill, afford medications, or simply buy groceries without doing the math twice. The Social Security Administration doesn't always send you a letter explaining how each change affects your situation. That's why we're breaking it all down today, one change at a time, in plain English. Let's start with the change everyone was waiting for, the annual cost of living adjustment, or COLA. Based on the increase in the Consumer Price Index for urban wage earners and clerical workers, Social Security beneficiaries and Supplemental Security income recipients will receive a 2.8% COLA for 2026. The Social Security Administration estimates that the average retirement benefit will rise by about $56 a month, from $2,015 to $2,071, starting with payments going out in January 2026. Now, $56 a month might not sound like a windfall, and honestly, many seniors feel that way. In an AARP survey conducted in September, 77% of older adults said a 3% COLA for 2026 would not be enough to help them keep up with rising prices. That frustration is completely understandable. But here's what matters for low-income retirees. The COLA applies across the board. It is applied to survivor benefits, family benefits, and Social Security disability insurance, as well as retirement benefits, and to SSI, a monthly benefit for people with low incomes and limited assets who are 65 or older, blind, or have a disability. SSI recipients see their maximum federal payment increase from $967 to $994 per month for individuals, an increase of $27 per month. For couples, the maximum SSI payment increases from $1,450 to $1,491 per month. The COLA is automatic. You don't have to call anyone or fill out a form. If you're already receiving benefits, the increase showed up in your January payment, or for SSI recipients, your December 31st payment. But here's a catch that a lot of people missed. Keep watching, because change number 2 directly impacts how much of that raise you actually get to keep. This is the one that hurt. While your Social Security check got bigger, your Medicare Part B premium also went up, and for many retirees, that took a big bite out of the COLA. The Centers for Medicare and Medicaid Services set the standard monthly Part B premium of $200.90 in 2026, an increase of $17.90, or just under 10%, from the 2025 premium of $185. Since Medicare Part B premiums are automatically deducted from most Social Security checks, that means the net increase many retirees actually see in their monthly payment is closer to $38, not the full $56 from the COLA. Only eligible recipients whose monthly Social Security benefit is $639 or less will be protected from the full premium increase by the hold harmless rule. Since the Part B premium increase is $17.90 and the cost of living allowance is 2.8%, that protection prevents your net benefit from actually going down. But it also means for those recipients, their entire COLA essentially went straight to the premium increase, leaving no real gain in their pocket. If you're a lower-income Medicare beneficiary, this is the time to check whether you qualify for the Medicare Savings Program or state. Those programs can help pay your Part B premium, sometimes in full. Contact your state Medicaid office or visit medicare.gov to find out if you're eligible. This change has been coming for decades, and in 2026, it finally reaches its endpoint. In November 2026, the full retirement age will reach 67 for those born in 1960 or later, a threshold that marks the culmination of a 42-year-long shift in raising the retirement age. If you were born in 1959, your full retirement age is 66 years and 10 months. If you were born in 1960 or later, it is 67. Why does this matter so much for low-income retirees? Because the decision of when to claim Social Security is one of the most consequential financial decisions you'll ever make. If you claim early, at 62, your monthly benefit will be permanently reduced. The exact reduction depends on how many months before your full retirement age you claim. On the other hand, delaying benefits beyond full retirement age increases your benefit by 8% per year, up to age 70. For someone living on a tight budget, that trade-off is real. Claiming at 62 brings money in sooner, but it locks in a lower check for the rest of your life. If you can afford to wait, even a few years, the higher monthly benefit can make a significant difference over time. If you're unsure what your floor is, log into your account at ssa.gov and check your personal Social Security statement. It shows your projected benefit at different ages. This may be the biggest single change in Social Security in decades, and if you're a retired teacher, firefighter, police officer, or federal employee, you need to pay very close attention. The Social Security Fairness Act was signed into law on January 5, 2025. It ends the windfall elimination provision and the government pension offset. These provisions had reduced or eliminated the Social Security benefits of over 2.8 million people who received a pension based on work not covered by Social Security because they did not pay Social Security taxes. In plain terms, for decades, millions of public servants had their Social Security benefits slashed or wiped out entirely, even though many had worked second jobs or part-time work where they did pay into Social Security. That's now over. As of July 2025, the SSA completed sending over 3.1 million payments, totaling $17 billion, to beneficiaries eligible under the Social Security Fairness Act, 5 months ahead of schedule. The average WET reduction was $350 per month. That amount is now restored. If you believe you were affected by the WEP or GPO and haven't seen your monthly benefit go up, check your My Social Security account online or call the SSA at 1-800-7-721-13. Some complex cases are still being processed. And if you never applied for spousal or survivor benefits because of the GPO, you may now be eligible, but you need to apply. This change is especially meaningful for low-income retirees because $350 a month can be the difference between getting by and struggling to survive. Here's one you may not have seen covered anywhere else, but it's genuinely useful for SSI recipients who work or have family members, helping them manage their finances. In April 2025, Social Security started using a Payroll Information Exchange, or PI. The SSA can use it to get monthly wage information correctly from payroll data providers, but only with your permission. You might not have to report your wages every month if the SSA receives them through PI. For SSI recipients who are working or reporting, this could save a significant amount of time and reduce the risk of overpayment notices caused by late or missed reports. To enroll, you can fill out Form SSA 8240, available on ssa.gov. You choose whether to participate. It's not automatic. But if you're an SSI recipient who earns any wages, this is worth looking into. Fewer reporting errors can mean a more stable benefit, month after month. If you're collecting Social Security before your full retirement age and you're still working, The retirement earnings test is something you need to know. In 2026, beneficiaries who will not reach full retirement age until a later year have $1 withheld from their Social Security payments for every $2 in work income above $24,480, up from $23,400 in 2025. So if you're 64 years old, collecting Social Security and still working part-time, you can now earn up to $24,480 in 2026 before your benefits are reduced at all. For example, if you earn $40,000 from work in 2026, your benefits for the year would be reduced by $7,760, half the difference between $24,480 and $40,000. Two important things to keep in mind here. First, the withheld money isn't gone forever. Once you reach full retirement age, the SSA adjusts your monthly payment upward to account for the benefits that were temporarily held back. Second, once full retirement age is reached, the earnings test disappears entirely. There's no longer any benefit deduction, no matter how much you earn. For low-income retirees who depend on part-time work to supplement their Social Security, the higher threshold in 2026 means you can earn a little more before it starts to affect your check. That's a modest but real benefit. Now, here's the one I promised you at the beginning, and it's a big one. As part of legislation signed into law in July 2025, Congress created a brand new tax deduction specifically for Americans age 65 and older. The new senior deduction allows seniors to deduct from taxable income up to $6,000 individually, or $12,000 if married filing jointly. To qualify, filers must provide their Social Security number on their tax return and be at least 65 years old. The deduction is in effect from tax years 2025 through 2028. It applies to taxpayers 65 and over, regardless of whether they itemize their tax returns or take the standard deduction. The White House estimated that an estimated 88% of seniors should not have to pay taxes on their Social Security benefits because of this deduction. That's a major shift for people who've been paying taxes on their benefits for years. But here's what you need to know if you're a lower-income retiree. The benefit of this deduction depends heavily on whether you already owe federal income tax. Many lower-income seniors already have zero tax liability after applying the standard deduction. For them, an additional deduction offers no further benefit. Since it is not a refundable credit, the deduction phases out for taxpayers with income over $75,000 for single filers and $150,000 for joint filers. So who benefits the most? Retirees who are receiving a combination of Social Security, pension income, IRA withdrawals, or part-time wages. People whose total income falls somewhere in the middle range, where federal taxes on benefits have historically been a real burden. If you're not sure whether this applies to you, the single best thing you can do is talk with a tax professional or a free VITA tax aid. VITA Volunteer Income Tax Assistance provides free tax help to people who generally make $67,000 or less, are disabled, or speak limited English. You can find a site near you at irs.gov. Don't leave this deduction unclaimed if you're eligible. It could meaningfully reduce your tax bill for the next several years. Let's run through all 7 changes one more time so nothing gets forgotten. 1. Your Social Security benefit went up to 0.8% this year, an average of $56 more per month. 2. Medicare Part B premiums also went up to $200.90 per month, which offsets some of that COLA increase for most beneficiaries. 3. Full retirement age is now 67 for anyone born in 1960 or later. Knowing your FROL matters enormously when deciding when to claim. 4. The Social Security Fairness Act has restored benefits for millions of public sector retirees. If you were affected by the WEP or GPO and haven't seen a change yet, contact the SSA. 5. SSI recipients who work now have a new option to automate wage reporting through the Payroll Information Exchange. Fewer headaches, fewer errors. 6. The retirement earnings test limit increased to $24,480 for 2026, giving working retirees a little more room before benefits are reduced. And 7. A new $6,000 senior tax deduction, $12,000 for couples, is available for the 2025 through 2028 tax years for Americans 65 and older, as long as your income falls within the eligibility range. Knowledge is the first step, but the second step is taking action, reviewing your benefit statements, calling the SSA if something looks off, and talking to a trusted tax professional or financial counselor about how these changes specifically affect you. If this video helped you understand your benefits better, please give it a thumbs up. It helps us reach more people who need this information. Subscribe so you don't miss our next update, because Social Security rules keep changing, and we'll keep you informed. And leave a comment below. Which of these 7 changes surprised you the most? We read every single one. Take care of yourself, and we'll see you in the next video. All information in this script is based on official Social Security Administration guidance, published federal legislation, and publicly available reporting as of June 2026. This script is for educational and informational purposes only and does not constitute financial, tax, or legal advice. Viewers are encouraged to consult a qualified professional for guidance specific to their individual situation. Share,